Hey, Small Business Safari, we are back. We're ready to roll. And if you are not ready for this episode, stop, pause, wait, hang on. All right, now you're back. You're ready. You want to know what 2024 is going to look like? We're not going to tell you, but we've got an economist who has admittedly said we can see what's going on in the past. We can only kind of tell you what's going to happen in the future, and it's up to you to figure out how to make it happen. We have Mischa Fisher on, who is an economist who I've listened to speak at a number of conferences in the home services space and clearly has one of the best and most unique perspectives on economy and where it's going without saying, hey, look, man, I know exactly where it's going to go. Because he even said, I think I've heard him say, hey, if I already knew, I wouldn't be sitting here talking to you guys about it. So, Mischa, welcome to the Small Business Safari. We're looking forward to having you on and kicking around for our audience.
Well, thanks for having me on and looking forward to the conversation.
So you guys met in Vegas, right?
So I met him out in Vegas. I listened to him talk. I did introduce myself to him for a minute. And I had 2 pages of notes when I was done.
Mischa, did you lose
he's the first. Yeah, he's the first and last person to go to Vegas and take notes.
That's true.
I'm assuming
I wasn't even hungover then.
You were trying to drag Mischa into the sports book so you could just pick his brain and all the data analytics, right?
Dude,
I bet you're just vicious on a fantasy league team.
No, I have the good sense to try and avoid it. It's the sort of thing where you go up and then you go to 0 if you get too confident. So I do my best.
That doesn't stop Chris. That doesn't stop Chris at all.
Oh no, yeah, no. In fact, I had come off my heater the night before at the poker table and came back to exactly $100 down. So no heater. Yeah, no, of course not. Of course not. So, Mischa, before we get started in talking about economics, when you grew up and you were growing up, is that what you wanted to be? A guy sitting there saying, I'm going to look at the economy all the time?
No, not really. I actually had wanted to go into the physical sciences. I thought science, engineering, that sort of thing would be really fun. Build telescopes or howitzers or something along those lines. I thought would be a lot cooler.
Telescopes or howitzers?
Look at cylinders.
Blow people the hell up. Let's go.
One or the other, or both.
Yeah.
So how did you get into the study of economics?
Well, it's quite interesting. So I studied it in college, which is, how most people get into it. And then I ended up doing something I hadn't planned to do, which was spending almost a decade in Washington, D.C., working for the U.S. Congress. So for all the taxpayers listening, I'm sorry, I did my best. But the goal was to, just go there for, a couple months and kind of figure it out, get a neat experience. But I ended up staying for the better part of a decade. And then knew I didn't want to do it forever, didn't want to be a lobbyist. So I thought, well, what's a good sort of force multiplier for that existing experience, but is something different? And that was, go study statistics in graduate school. So that's what I did, and then went into economics afterwards.
So was it just frustrating being in Congress? And I think you were also the advisor to the governor of Illinois. Is that correct as well?
That's correct. Yeah. One of the ones that did not go to prison.
Okay. Well, good job. Kept him out of prison. But to give them all this information and then just see them either ignore it or go a different direction, I'm assuming you saw that all the time.
It sort of depends in terms of the level of frustration, what your expectations are. So, I mean, Congress, people look at it and they expect it to do things. But remember, the institution is just designed to prevent things from happening. And if you put it at that framework, that part's not frustrating at all, because the place is designed to sort of vent energy, but to prevent us from doing things that cause more harm than they do good. You could quibble about how effective it is at that. But certainly that was the perspective I had about it. And, I feel like in the time there, it was pretty rewarding in terms of some of the things that we were able to do. And it's all marginal. You're not making any big sweeping changes to anything, which again is probably a good thing, because that's what it's designed to prevent from happening. But, we did some really cool stuff. And like the last year I was there, we did a bunch of work where we changed laws around getting veterans who'd driven trucks to have a streamlined access to being commercial truck drivers, right? It didn't exist in the law. We found a way to say, hey, people have experience. Let's not bog them down in bureaucracy. Let's find a way for people who've been doing this for the military to be able to go do this in the private sector without a lot of headache. And that was, that was pretty cool. And so you make those sorts of changes.
Yeah, well done.
So that sort of thing's pretty rewarding.
I actually had a guy in college who, so I was in college during the first Iraqi war, and he was a reservist. And, again, in the late 80s, nobody was getting called, right? Here comes the war. And we had to stand by the phone. We actually had to put a note by the phone saying, don't be a dick, answer the phone correctly, because he only had 24 hours to report. And he was a driver. And, the first war was driving in. So he was going
Right.
to school to become an engineer. That's what we're there for. But his specialty was driving. And now I could see where you're right. There's no reason to make this hard. They know how to drive, and they know how to drive some pretty crazy stuff.
Yeah, exactly. And so, that part of it was actually pretty rewarding and pretty cool. And it does allow you to touch on a lot of different aspects of the economy that are pretty interesting. It's a lot of exposure to that you normally wouldn't get when, you're two, which is when I started it. I was pretty young. And Congress is, this is something we don't talk about, but Congress is kind of run by pretty young people. I mean, in terms of all the staff work, people are by and large in their early mid-20s. If you're in your late 20s as a congressional staffer, you're kind of old by the standards of the place. So maybe that explains a lot in people's minds, or maybe they view it as a good thing.
No, I know it's good. My son was an intern up on Capitol Hill, and we got a tour of Congress, and it was crazy. It's just a ton of young people answering the phones and, putting together reports. And then all of a sudden the doddering old senator comes in and they just hand him a stack of things, and then they go vote, and then they leave and go get a cocktail.
Yeah. That's pretty much it. And it used to be more pronounced, but yeah, it's definitely, there's a lot of heavy drinking goes on too. But,
all right. So let's just summarize the first opening act of Mischa's discussion. The government's designed to not do anything. So with that expectation, things are great. And a lot of young people come up with a bunch of stuff. So a lot of old people can go vote quickly and go drinking.
Pretty much.
Yeah.
Yes.
That's it.
Sign me up. I think that's going to be
101.
my next career. Don't do anything. Don't design never to do anything. And you can make sure I get a cocktail quick. All
Yeah.
right.
Probably get a
There
referral for that gout in DC for you.
Yeah, perfect.
Yeah.
All right. So Mischa, you move out of DC. You moved in. Well, you moved on and went to college, and then what was your first economic job or economist job? What was that?
So my intention was just to go right into the tech sector and do math for a company, because it's a pretty demanding, compelling work in the sense that it's intellectually quite hard to do. But then when I was coming out of grad school, I was offered a spot to go lead up the research department for the Illinois Department of Commerce, and thought that would seem pretty cool in terms of trying to change and improve and the overall economic climate in the state. It's got kind of a reputation for not being the friendliest state for economic investment, to put it mildly. So I thought that would be pretty neat. And, similar sorts of things. There's some frustrating aspects of it, but it was pretty compelling in terms of trying to reshape tax incentives and trying to reduce bureaucratic burden and trying to reduce costs of just sort of standard overhead to encourage people to invest more. That was a pretty neat couple of years. I don't miss it, but it was neat to get to do it.
So obviously our audience, a lot of us were entrepreneurs, either aspiring entrepreneurs, and you were in the middle of what is probably the largest bureaucracy we could even think of. When you went into your first job, did you feel like you had an entrepreneurial spirit as you jumped in there, or did you feel like, I'm here to do my thing. I'm gonna be a cog in the wheel and grind it out and make a difference?
It was a little bit of both. So I definitely came from sort of small town entrepreneurial environment, grew up on a farm, and didn't have any existing social exposure to these environments. So it was a matter of gradual exposure in terms of how things worked. And I did enjoy it for a little while, but eventually that nature of saying, well, we're not actually doing anything. We're trying to marginally improve things for people who are doing things, but you're not a doer yourself. And eventually I kind of got tired of that. And that's what made me want to get out of that environment, was going and doing something entrepreneurial and, be a doer, not a talker.
Yeah. So talk about that. What was that first foray into doing that work?
So the first foray into it was as a youth. I worked in I worked for the power company vehicle yard when I was, probably younger than I should have been, early teenager. Then I worked a little bit of construction, grocery store, distribution, all sorts of, standard sort of blue collar jobs all through high school and college, the whole thing, basically starting in the 8th grade and going through the end of university. And then the government stuff was kind of a break from that. And then I went back to it when I was the chief economist for Angie. So that was my back into sort of doing things and trying to make a business that works for people and is competitive. And then now I'm at another tech company where we're doing the same thing.
So right now, your current role is you're a chief economist for a tech company, but also you're an adjunct professor at Northwestern.
Yeah, so I teach applied stats at Northwestern. I was Angie's chief economist. Now I do less of the public-facing economics work at a tech company. So it's all internal. It's not external facing, but that's my day job.
Gotcha. All right, so you got a wealth of knowledge, and that's one of the big things that I really enjoyed as you put it all together. One of the things that I enjoyed in your talk that I'd like you to touch on a little bit more is that in the last 20 years, here we are in 23, from 2001 to 23, let's call it 20 years, Was that good math for the stats guy?
It is for us, but not for Mischa.
I probably blew it.
That's-
Didn't I?
that's
All right.
I'm wearing glasses, so I look smarter.
Okay. Yeah, I
There you
saw
go.
that. That's
Yeah.
nice. That's a nice call. So we've had two big events, right? We've had the 2008 recession and COVID. And you talked about how that impacted specifically the housing industry. But I'm really interested in your take on looking back historically on those two events as we look at 24, 25 coming up.
Yeah. So, and just to give listeners a little bit of context, when we were last together talking about this, if you look at a chart of global GDP, it's just up and to the right for the whole thing, except for two drops that appear. And those two drops are COVID and the Great Recession, both of which had a very, very strong connection to the U.S. housing market. Right. But that's not true for all recessions, but in this case, both of those have a very, very deep connection. The first being that it kind of originated in the housing market, right? We had a debt boom, and people debate about the reasons for it. So we can bypass the debate or jump right into it. But we had a crash in housing prices, and then a very slow recovery. And when we had that crash, we had a lot of people exit the industry. We had a massive decline in the number of houses being built. Like dramatic 60 to 80% drops depending on different parts of the country, and house prices went down, and homeowner equity as a result went down. So consumers felt poor, people weren't working in the industry anymore, and people stopped building new supply. And then the second big dip was COVID, and none of those things were true. With COVID, what happened was interest rates were dropped again, but the labor market held up. And because we've been underbuilding supply, we preserved that overall bottom of the housing market. And it's important for people to remember that the price of a house isn't just the sticker price, right? It's really the cost of the asset, so what you buy the house for, and the interest rate. You had to interact those two things to see what the actual price is. And when you interact those two things, houses became cheaper than they'd been in decades at the early onset of COVID when interest rates dropped. And so people did the smart thing. They started buying more, but nobody was around because of that first big drop. Nobody had been in the industry, and we hadn't been pulling people in for the last 10 years. And so it's the combination of those two things really left us in an interesting spot right now in terms of the market, where asset prices are up. We haven't pulled people in. And then the second order things that are coming out of that right now are the interest rate lock-in that's now starting to get a lot of attention in terms of nobody has any incentive to sell their house because they have a cheap mortgage, but there's no existing supply. And because of that lack of volume transacting, the asset prices are being held up despite rising interest rates. So because of interest rates have shot up so much, we should have expected to see a decline in house prices, but we haven't because of those other things.
You ready, Alan? Or you want me to jump in?
Go ahead. Yeah.
So I think that's the important parallels. Those were two very significant events over the course of 100+ years, whenever GDP first got marked in. And you're able to distill it down into a supply demand based on assets of the homes and the supply we've got now. As we get ready for 24, right now, I think we're all pretty much resigned to the fact that it's going to be a little slower than it has been over this boom. We're going to have that hangover a little bit. It's going to be a little slower. It's an election year. It's always slower for us in the hosting business.
I want to ask him about that.
Okay, then
No.
go.
Well, I hear you say it, and I hear a lot of other business people. It's like, oh, it's an election. Things are going to slow down. And I don't know anybody. I mean, once in a while you hear somebody like today I'm in commercial real estate. We were at a shooting range. And yeah, I'm assuming if a Democrat takes over an office, maybe I don't want to expand my shooting range, but most people, I don't know anybody that makes a economic decision based on an upcoming election. And yet I hear it all the time. Are we just lemmings as consumers, Mischa? I mean, is it that simple?
It's not necessarily that simple. So there are effects that do happen in election years. And the first is that whichever party is in the White House, some subset of the consumers who are members of the other party, you see their overall economic sentiment go down. That's pretty persistent. And structurally, there's no reason not to, right? People are bummed out that their preferred candidate's not in the White House. And as a result, they feel less good about things. And that has a non-zero impact on overall spending in the economy. I don't think that explains most of the negative sentiment. Most of the negative sentiment that exists right now is inflation. If you draw the correlation line between the price level and what people are feeling about the economy, that's where you see a very, very strong relationship where the price level started going up and people started feeling very pessimistic about it because people don't like getting poorer This is one of the things that really holds up from behavioral economics. Behavioral economics, you've got to sort of do a careful job of filtering out what works and what's just designed to sort of be interesting and sell books, but isn't actually very good science. And there's a non-0% of that field that's in there. But one of the things that really is good science is that people really, really don't like getting poor, disproportionately more so than they like getting richer. So if I give you an even odd chance of getting $10 or losing $10, you don't weight the two equally, even though statistically you should. You rate the prospect of losing $10 as worse than gaining $10. And so that's the main root of the negative sentiment. You should expect some switch in terms of overall economic sentiment following that. The only thing I'll say right now is that you do see a persistent drop in sentiment, and this is something that I don't think enough economists talk about, that came on around the Afghan withdrawal. When we did that, consumer sentiment dropped, and it's stayed down there. It's just been lower persistently over that last couple of years.
Wow.
So I could see a reset effect happening if the White House changes hands. But that's only it appears because of a small subset of the electorate, not because it's the entire thing. Obviously, elections, if there's a change of expectation around inflation, whether or not whoever's in the White House actually changes policy, that can impact people's expectations around inflation, right? So there's two pieces of it. There's what the actual policy is, and then there's what people's perception of the policy is. They can both have impacts on people's expectations around inflation. That doesn't necessarily mean that they will have the exact same impact on what the actual outcome is, right? So you can imagine people saying, well, because there was this change in my expectation around policy, I'm going to expect prices won't rise as much next year. And as a result, they don't. Economists will argue about the size of that effect, though.
Huh. How about, I didn't even think about the Afghan reset, the pullout from Afghan.
I can't even imagine that would impact that many people mentally, just because I know so many people that are oblivious to what's going on.
Yeah, but it sounds like the data supports it. And I mean, that's why Mischa's on, because we didn't know it.
Yeah.
And now we do.
Yeah, I mean, if you look at it was a pretty big news story at the time. We're not talking about it as much anymore, but it drops. And I don't want to overstate the magnitude of it, but you can see it in the trend.
Huh. Yeah, I would have actually said non-impact. I mean, I was there, but just like a lot of political noise, sometimes for people.
It's got to be an interesting time for you because, the economy has just been so heated, superheated maybe. And here you have the government trying to shut it down. And yet people don't want it to. Yeah, I mean, people want inflation to go down. They want their interest rates to go down, but they don't want to stop spending. And I don't know, do you look at this dispassionately and you're like, oh, this is kind of an interesting dynamic we've never seen before? Or, any comments on that?
In terms of the interest rates?
Just the fact that it's just, to me, it's, I've been on the planet for 60 years. I've been through a lot of recessions, and this is the first one that I remember where the government is just intentionally trying to just crush the economy temporarily, and they're trying to time it just so that it slows down but doesn't crater. And so it's just a very interesting dynamic to me where the economy doesn't want to be killed and the government's trying to kill it just so that we can get inflation under control.
Yeah it's that's always the challenge, and you can get into some really interesting debates about the role of the Federal Reserve in the economy. But and just to get listeners on the same page, in case you're not familiar, the way I like to phrase it as the Federal Reserve sets the price of the most important thing in the world, and that is the US dollar, right? It's the most important commodity in the world is the United States dollar, and they set the price effectively. I'm oversimplifying it, but that's, I think, a useful heuristic for how you envision it. And the argument is the economy was running too hot, so we got inflation. And so then to tamp down inflation, they are going to make the price of dollars more expensive so that it's harder for you to borrow and grow your business. It's harder for you as a consumer to expand your spending. And as a result, you cool down the economy. The challenge is every time we do that, well, not every time, but almost every time we do that, we create a recession, because what happens is people get shocked and then you stop spending, and then your supplier stops having something to sell you because you've stopped buying it. And so then they lay off their staff, and then their staff stops spending, and you end up with a negative reinforcing cycle, right? So the staff have stopped buying because they just lost their jobs. So then other people have fewer people to sell to, and then they lay off their staff, right? So that's the runaway effect of why you get a negative cycle, and the inverse of that is a positive cycle. What's been surprising about this one, though, is that we've raised interest rates at a faster rate than we ever have before. So everybody was expecting this to cause a recession. It's still open-ended about whether or not we will have one. My argument is we're kind of in the middle of one. It's just so spaced out, we're not calling it that. So it's hitting different sectors at different times. And traditionally, it sort of has to hit a bunch of sectors at the same time. And, again, this is a thing that we'll debate about it and then come to a agreement about what actually happened in 3 years when nobody cares anymore.
That's right.
So this is again, the distinction between being a doer and a talker. So we'll see what happens. I will say that the overall level of interest rates, while high, aren't as high as they've been in the past, and the economy still finds a way to function. And because the biggest thing that people face with interest rates is their mortgage cost, and because most people have 30-year fixed rate mortgages, we're less susceptible to that. If you're talking about other countries, Canada to our north, for example, they have by and large floating mortgages. So there's a whole bunch of people out there who pulled out pretty expensive mortgages and had that great 2% something rather mortgage rate, and now they're having to refinance at 5 or 6, right? So that economy is going to have to respond more immediately to the rise in interest rates. Whereas for us, it's like, okay, well, you're going to have people buying new houses at a lower rate, but most people in any given year aren't buying a house, right? Overall house volume transaction is like 4 to 6 million a year, whereas you've got 100+ million people in their homes that they own. So it's, less responsive. It's only a tiny subset of overall households that are in that process of buying at the current rate. Refinance activity tanked and has gone by the wayside. That'll come back up as we go back through another rate dropping cycle. But, the short version is it's an interesting cycle, but they all are, right? Every single one is a sample size of one. My personal on the record forecast is we're in a recession right now, but it's spaced out. So we're not calling it that. It's hitting different sectors at different times.
Yeah. To back that up, I would, to bring it to Main Street, as a remodeler and a handyman here in Atlanta with, we'll do 6.5 million this year. So we see a lot of houses. What I've seen is that in neighborhoods, back to Mischa's point, is that all sectors got hit. So when 2008 hit, it was real estate, but real estate bled into package shipping, real estate bled into, and it just crept into all these other industries.
It didn't creep. It happened overnight.
Yeah, it didn't happen fast.
Yeah.
But here, what's happening is if you go into a neighborhood, no, these 20 people don't work for UPS here in Atlanta. These 20 people don't work for Coca-Cola. These 2 people work for Amazon out of Washington. These 2 people might work for a tech company out of Arizona. These 2 people might move from New Jersey. He may be laid off, but his neighbors are still working. So he is going through a household recession, but the other 2 are still sitting there spending money. So I'm definitely seeing that because we are off this year, coming off our high. Our leads are down they'll end probably at 15%. Now our revenue is up. That's because I leaned into the recession that I thought was coming this year, and we advertised a lot more. So we're going to end up having a really good year. But now we're looking at 24, and here we go again. If you were in the home services space, what would you recommend? Do you lean into this? Do you advertise more? Do you buckle down and batten down the hatches, lean it up? What should we do?
I would say have a higher variance strategy. So what does that mean? It means be able to be flexible where the opportunities come up, right? If something is broad-based, then you don't have a lot of options. But because it's selective, like what we were talking about, maybe you can advertise more if you find some channels that are suddenly discounted relative to where they were because they're going through their own little localized recession in that area. And you can say, okay, well, this is a good deal on that market channel. Same thing for, whatever your marketing channel happens to be, whether it's a leads-based marketplace, advertising, etc. So find those opportunities there. And then on the actual what you're doing side of it, make sure that you've got a strategy there to say, well, I'm going to take advantage of there's a shift in the market and people now want to hit this price point instead of this other one that I was over indexed on. So be flexible there, have relationships with more suppliers than maybe you're accustomed to. And I've noticed a huge amount of variance there. So some people say, well, I know every single supplier in my metro, and some people sort of have their one go-to, but you might be able to find more of a gap there in terms of what you're sourcing things at than you have in the past, because different people are exposed to market fluctuations at different rates. Like I remember it's sort of the inverse of during COVID when, because the price of certain types of lumber had gone up so much, lumber yards weren't even bothering to stock it because they didn't want to buy at the top and then be stuck holding that inventory that they had
Right.
acquired at that price. So they just didn't bother. And so now you're finding, potentially more fluctuation there. Like for consumers, the big advice right now is make sure you're shopping around on mortgage rates, because you're finding a much wider spread across different mortgage providers than you have in the past. So some people are still at 8 now. Like some people you can maybe get in the high 6s. I've seen some people doing points buy downs into the 5s. So you've got a much higher gap than you have in the past. Do the same thing with how you're sourcing your materials. And then the final thing is labor flexibility. If you do find demand go down, the industry learned the hard way that it's really painful to just lay everybody off and lose people from the sector, right? Maybe that makes sense for you individually, but for the industry, it's terrible because you lose all that skill set, you lose that training, people don't want to come back. So come up with dynamic ways to reward your labor that impact some of the, or that allow you to hedge some of the revenue risk that comes up, right? So if you're concerned about revenue being down 20% next year, but you're indexed entirely on certain forms of fixed payroll, that might be pretty expensive for you on your margin. But, you mentioned tech, right? So tech's gone through kind of a recession over the last year. And it could have been worse, but what a lot of tech companies do is they tie employee compensation to equity. And so company valuation drops, employee comp drops, but they don't have to lay people off, right? Because their overheads dropped too. So I think that more sectors can kind of learn that lesson about finding ways based off of demand, whether it's bonuses, whether it's, if you're large enough, maybe you could find some sort of like private incentive ownership deal that incentivizes people to do it. But there's a lot of room to innovate in the sector in terms of how we pay the individual people doing the work. And so I think that it's also going to be a rewarding year to figure those things out if, people are looking at 20% less revenue.
I know if you're driving around in your car right now, you're going to hit pause and you're going to go back like 3 minutes and re-listen to that one, because there's a lot to soak in and a lot to figure out. Because if you're doing what I'm doing, which is at the end of 23, I'm trying to plan out my 24 year and trying to do my predictions, see what's going to happen. What I just heard was where you advertise, you probably want to make sure you're still flexible in how you do it and really monitor it. And the other thing I'm going to do is we're our single source supplier. We actually, Home Depot's 60% of our spend because of our handyman biz, and then 20% comes from a major supplier of windows and doors here. We're probably going to go look at them after what he just said. And so that's the kind of stuff you get when you get somebody who's looking at this broad picture and looking at the major economic structure in here, and you're sitting here on Main Street just taking care of days. Okay. Woo, I know I'm spinning, dude. I am so spinning. I've been writing like a fiend again.
You
doing
have.
it again. You actually another gold nugget for everybody. Mortgage rates. Everybody probably listen to this podcast has a house, and so it's time to, if you're shopping, shop hard, because there's a wide variance there. And that was something that was not true 2 and 3 years ago. I mean, you'd be lucky if you can get an eighth anywhere, difference. And so that's also, I think, another big gold nugget for everybody. Mischa, let's shift gears a little bit and talk about one of the things you mentioned that I really enjoyed was, if we had one indicator to look at, what indicator should we look at, and how could we react to looking at that one?
Weekly unemployment claims. It's the clearest answer you'll ever get from any economist.
Right. I know. When he said that, I'm like, I actually nudged the guy and said, dude, that's like the first economist ever who just directly answered a question.
Yeah, most people like to hedge their bets and not be wrong. Weekly unemployment claims. You don't need an economist to interpret it. If you just Google the weekly unemployment claims, you'll see it. It comes out every Thursday and it's lagged about 10 days, if I remember correctly. So it's not quite leading. But the reason why I recommend that one is it gives you a sense of how many people lost their jobs in the last week. Again, with a slight lag, but lots of data is lagged significantly more than that. You're talking about 6 to 8 week lags on the unemployment numbers, because those numbers come out the first Friday of the month. So already it's monthly instead of weekly. And then most of the data comes from the prior month's first 2 weeks. So you're looking at like a 6 week lag on it. And it can kind of mask the story. Whereas right now, in any given week, 200,000-ish, 250 people lose their jobs, right? Sounds like a lot, but it's a big country and it's a big economy. And if that number starts spiking, then people start panicking in a way that causes them to really halt spending, and then it makes the problem worse. Whereas if that number sort of stays relatively even, so it doesn't spike up into the high threes or something like that, then people by and large say, okay, well, it's plodding along at its normal rate. And it's just the most real-time single thing. You can't pay attention to the stock market. That's a terrible thing because so much other stuff is going on. And it tends to start recovering before the economy gets bad because people are looking 6, 9, 10 months ahead and saying, okay, well, that's where the uptick is, so I'm going to buy it now. Right? People are trying to anticipate the future there. So it's not a great indicator. It's also, it can be pretty volatile. You can just get like 10% swings in certain days. And it's also trying to anticipate what interest rates are doing and bond rates and all sorts of other stuff. But just, are people losing their jobs, yes or no? And I can see that every week with almost no time delay. That's a great indicator. And so that's the one that I recommend.
I love that one. And it's easy.
It's easy.
You know what I'm Yeah, it's
Yeah.
easy.
Yeah.
Even I could look at that and figure it out.
Even you.
Even I can figure that
There
out.
you go. And and if you want to get more complicated, you can do that. You can use it as a gateway drug to say, okay, well, that's initial claims. How about continuing claims? So how many people are still filing after, like 10 weeks, right? So are you seeing a lengthening spell of how long people are jobless? You can then look at the unemployment rate and the labor force participation rate. And you can look at all that stuff later if you want to, but that I think is unnecessary for most people's purchases, which is just, hey, what's going on? How many people lost their jobs last week?
There you go. Fascinating. I love this stuff. Well, so you said you had a lot of questions. I'm going to keep rolling if you don't have them.
You can go ahead and keep
All
rolling.
right.
I've got obscure questions.
Okay. So just for a minute, global economy, people started talking about that. So I started my business in 2008. I left the financial markets. I was in financial services, and I went with a business because I had read a book called The World is Flat by Friedman, and I did not want to get outsourced because I didn't feel like my business could outsourced overseas. In the world of global economy, which I think has been used now for the last 40 years, what do you think our triggers are going to be from a global economy perspective to here we are starting our own businesses here in the U.S.?
So just to clarify the question, you mean like what's going on with outsourcing, or can you elaborate a little bit?
So the global economy. So where should we be worried about the global impacts to what we're doing here in the U.S.?
Oh, in terms of what could hurt supplier demand.
What could hurt us, knowing like the Ukraine war popped up,
right.
Boom, there goes cabinets. I don't know if you guys knew this, but it was cheaper at the time to cut down oak trees here in the U.S. and Canada, ship them over to Ukraine, have them made cabinets, brought them back, and we would install them here in the U.S.
Well, a lot of the birch plywood came out of there too, right?
Right.
Yeah.
Yeah. They weren't just the wheat basket of the world. They had that going on. So that's, I mean, I know it's a big question, but you can't say, oh, there's going to be another war in Asia. Let me tell you, here's what I predict. But
we got the Middle East going on right now.
Yeah. So how much or little should we be paying attention to that?
I mean, I think people should pay attention to it, not just because of their bottom line, but also, just to be a good civic citizen in an independent republic to do that. In terms of potential risk, this stuff is unpredictable by nature, but it does speak to having a diversified supply chain and being flexible. A lot of people really got burned. Imagine if you could have hit supply at the peak of the COVID demand, but you couldn't because your cabinets were, overseas and, independent of the war before that even happened, just the supply chain bottlenecks.
Oh, yeah.
Right.
Yeah,
so
I was just talking to somebody who said, did you know that I could have installed 30 more kitchens, except all of my stuff was sitting out in the containers off the sea and couldn't get it in.
Yeah.
I'm like, yeah, I hear you, brother. I know.
Yeah. So, people are very bad at factoring that into their cost savings. And they say, yeah, but I'm, on margin, I'm improving my margins by, 2% by getting my cabinetry from somewhere else. So certainly some folks have larger players in a lot of industries have figured this out. And so you see more diversification of supply chains, stuff that was, early on with lockdowns in China, a lot of, some of that production's been shifted over to Vietnam. That's a big classic one that we've seen. Obviously, people right now are responding to Ukraine. Hopefully the bull case there is the war gets resolved and then all that supply comes back online and that risk is removed. Nothing's guaranteed, but we can hope that that doesn't get worse. Same thing for Middle East. Obviously, we hope that gets better instead of getting worse.
Amen again.
But it's just one of those things where you have to build some flexibility in and never expose yourself. I on a personal level, I do some investment in rural Colorado stuff. People respond like wildfires aren't a thing, but they are a thing. So build that into your investment plan, or you're being pretty reckless with your plan. Just because no wildfires come through that area in 100 years doesn't mean it couldn't. And it's the same sort of principle regardless of what your business is. Obviously, if you're not doing property investment in rural Colorado, you don't have to worry about wildfires necessarily, but you should worry about whatever that unlikely but quite devastating thing that could happen does happen. So have diversified supply chains, have multiple relationships, have relationships that are good enough where you can get to the front of the line if there is a backlog, and it's up to somebody's discretion if you get the material or somebody else does.
Yeah, it's synthesized that one. Having good relationships saves your buns when things go the wrong way. But diversifying your relationships, it's a lot more work and it's harder to manage. And you're right, guys. You're probably gonna have to work a couple hours extra a week. But welcome to the world. That's what we got to do. You go out there and solve the problem, and you're gonna be in a better position when something comes up that you had no idea was going to happen.
Like what's the net dollar value of those 30 extra kitchens?
Yeah, I mean, let's look at that number: 30 kitchens, bro.
That's massive.
He finally got him going, and the next thing hit, which was couldn't get appliances. But what he did to solve that one, to give you an idea, you can't get a certificate of occupancy doing a kitchen here in Atlanta, well, of course, across the U.S., without having a working appliance. And so a lot of these appliances that he was putting in were the 36 or 40-inch big ranges. He was taking 30-inch standalone ranges, plopping them into the $300 GE special and waiting for his stuff to come in from overseas. And
like
so
loaner ranges.
He's getting loaner ranges. Yeah. He went out and he bought 15 of them just to finish it off and get the CO. Yeah, of course. Because now he's not floating all that extra money. So
yeah,
I think that was a hell of a solve on the problem. I thought that was really cool.
Yeah. Yeah. I mean, that's a great practical solution.
Yeah. All right. So we're coming to the end here. And I just got so many more questions. But as you look forward to, let's say, I don't know how far you said, I think I remember you saying anybody who predicts more than 3 years is just flat out lying. They're not even an economist. I think I wrote that down.
Well, they could be an economist, but they're definitely being disingenuous about the nature of
not a good one.
So
what do you see major drivers or things that we hadn't talked about in the next 1 or 2 years? Well, I'll just take one, really.
Demographics is the big one. That's the most persistent above all this stuff, right? I mean, interest rates are powerful, but they do go up and down, and they get moved by other things. But something that's remarkably stable, but also not random in terms of how it interacts with the economy over time, so it means that it has a persistent effect, is the overall demographic distribution of the country. We don't have an even space of people at each age group, right? 1% of the population is not 1 year old, and 1% is not 2 years old, and 1% is not 3 years old, and 1% is not 100 years old. You actually get these spikes where 2% are 38 and 0.5% are 1. That's the sort of, so you can get like 4 times as many people in one age group than in another. And that curve is shifting over time. It's less of an impact for us than for other countries because we pull new people into the country at a rate that other countries don't. So that keeps us a little bit younger than we otherwise might be. But that is changing. We have fewer young people. Right now, we're sort of going through a golden era for the market where there's still demand from baby boomers and from millennials who are forming houses. But that's going to decline a little bit over the next 10 years, but it's going to open up new sources of demand. Right. So I think that the new sources of demand are twofold. The first is you've got tens of millions of people in the boomer age group who are going to want to age in place. And, like the price of healthcare, the price of elder care, all that stuff is crazy expensive and getting more expensive. So you might see some unit economic shift where it's worth it for people to retrofit their houses. I think that could be a growing sector in certain portions of the country. Right? This is obviously a very regionalized story as people move around. The other thing is, millennials as a cohort are pickier about where they live. They're doing okay financially. People like to say they're not, but they're doing okay financially, and are going to prioritize certain lifestyle components of their demand, and are now sort of hitting their peak professional years where their discretionary income is going to spike, and also peak child formation years too, and family formation. So both of those two stories are very much a demographic driven piece. And at the same time, demographics also interacts with the supply side. And in the trades, the smart money tends to work for itself. So you've got to be very creative around how you satisfy that demand. And, the idea that you can pull in unskilled labor and not pay, a really nice wage premium is going to get harder and harder for the sector. So you have to come up with more creative ways to keep scarcer people in the industry as older folks retire out of it. And as systems get more complicated too. That's another thing, right? Complex systems, if you're talking about modern buildings, every single component has to work right? Your rain barrier, your vapor barrier, your insulation, your electrical, all of these things are more complicated than they were in the past. And the consequences of somebody screwing them up has gotten a lot more expensive. If you've got a house that was all framed with solid wood and wasn't very well insulated, and, a plumbing pipe burst, the wood will dry out. But now it's a real problem if you've built an airtight house out of OSB and other sort of laminated wood products that don't respond very well to water, and now somebody screwed up your PEX fitting. That's a very expensive proposition, and that's gotten a lot worse for the sector. And so you really want to make sure that you're training people well and holding on to them, and demographics are going to make that harder. So that's a long-winded way of saying demographics on both the supply and demand side.
Love it. I'm partnering up with somebody here locally on the aging in place stuff, is where the and training the guys on how to do this stuff, because I'm seeing it in Atlanta. I didn't see it 10 years ago. I definitely see it now, though, that more and more people are moving mom and dad into the basement, or mom and dad want to stay in their house that they grew up in and that they raised their children in, and they want to stay there. And then millennials, the other thing, you're right, they're doing just fine when it comes to financials. And my big thing is, I'd say that's a bad word, the millennials. They're bad. They don't know what they're doing. But they're the first person to say, hey, what do you guys want to eat tonight? I'm like, well, let's go get something. No, we'll just call Uber Eats. Oh, okay. So you guys are willing to pay $10 to get your food delivered. Oh yeah, no problem. Okay. Our hourly rate's $185 for the first hour. And oh no, that's too much money.
Yeah. Yeah, it's pretty funny how people make those distinctions. You tell somebody they've got a $180 bar tab, they wouldn't think twice about it. But you say it's $180 for a qualified home service person to not burn your house down. Oh, that seems expensive.
Oh, that's too crazy. I'll find somebody else.
Yeah.
That's awesome. That's a great a pull on the demographics. I think that's incredibly interesting, and we're seeing it here in Atlanta. I definitely am seeing that. So, all right, Alan, you need to talk more.
Well, we left him speechless.
No. I mean, I had questions that weren't quite in your groove, because you're staying in the home services space. But
all right, well,
I'm just more curious about. No, just, you do data analytics in consumer behavior, and I'm just kind of curious what the role of social media is in that compared to the way consumer behavior was driven in the past.
Yeah, I mean, it's huge in terms of the fact that we are all, we talked about it earlier, kind of mini lemmings, right? So you can see trends change faster. So I guess meaningfully mapping the question to what a listener might care about, because obviously people have social media they watch, it can change things.
He's making my question a good question is what he's doing.
I know, I love that. Mischa, that's a great rephrase of the question.
Yeah,
not a very good question, Alan. Let me make it a better question.
Trends can change faster. People can have different expectations around what it is they're doing, right? That's the biggest one. And people now expect nicer homes than they have in the past. Right? Because before, you might, if you picked up a copy of, some fancy magazine somewhere, maybe it'll change your opinion. But now you see it constantly on social media. And if it engages well, you see even more of it. So people's expectations around having nicer homes is more pronounced. A broader array of features, right? Because if you see some novel thing that's going to perform well in the algorithm, so now all of a sudden people want, pick some whatever exotic product that they didn't know they wanted before, and now they do want it. So wider range of trends, and a faster change in terms of how people are expecting to get them, right? So everybody's into white cabinets right now, but that could change more quickly than it would in the past. And so you're going to see, I think, both of those two things being the big consequence of it. I'm not quite sure what are the other practical things. I mean, I think if you're in the selling business, obviously that's a new channel. Whether or not it's a profitable channel is a separate story. But more social media companies are really pushing, you saw this post, well, here, buy the product. And that applies to home services just as much as to consumer goods. Obviously, it's going to be lower volumes because of the higher price point, but it's still going to apply as an additional channel that you can pursue. But like all channels, it might be profitable, it might not. You've got to use your own discovery process there to figure out if that's the right channel for you.
Well rephrased and well answered.
It really was. I'm going to put my glasses back on so I get smarter.
There you go. All right. I think we got to jump into the final four.
Yeah.
All right. But before we do that, Mischa, how can people follow you, see what you're doing out there, and see the work that you're doing? Because it's phenomenal stuff, and it's really helped me formulate my 24 plan.
Sure. So, I mean, I post research out there. The easiest way to find it is just to track me down on LinkedIn. That's usually where I tend to put things. It can be a little sporadic depending on what I'm making publicly available and what I'm not, but that's the easiest spot. So just track me down on LinkedIn. If you're not a LinkedIn guy, then I don't know. Sign up for LinkedIn and then just follow me only.
That's it. LinkedIn. That's where you gotta go.
I looked at him on Twitter, and there were a lot of interesting posts, but one was I think it was a mountain lion that was going across your property.
Oh yeah, that's one of my properties in Colorado, and I was doing some footing inspections and left, and my game camera picked up a curious big cat.
It was huge.
Yeah.
Dude.
Yeah, I've seen some very large cats up there.
There you go. The big cat hunter economist, Mischa Fisher. I love it.
Yeah,
I'll go find him on
right.
LinkedIn. That's awesome. All right, Mischa, what is a book you would recommend to our audience to help them either in their personal or business life?
This is one where people usually have their favorite business book, but I tend not to recommend business books. I think you can get that from fun conversations at the bar, most of that wisdom, or you just have to learn these lessons the hard way. So I usually recommend classic literature to people, and pick a book, but pick something from 1950 or earlier, and read or listen to that. So I've read a bunch of good ones, but I tend to really enjoy old fiction. So here I will go off the wall and recommend something that I don't think anybody's going to read, but they've also never heard the recommendation before, and that's Of Human Bondage by Somerset Maugham. It's not a racy book, even though the title is like that, but it's Somerset Maugham, classic author from the last century. It's considered kind of his magnum opus. And it's just all about humans making stupid choices in their personal lives. You get a lot of wisdom from that. And even though it's not a business book, that's what I'm going to recommend.
I can say that's a recommendation that will never be duplicated.
That one is not the E-Myth, my friends.
No.
Oh, E-Myth. Oh, E-Myth. Oh, I mean, Of Human Bondage. Do what? What are we listening to? Well, it's true crimes. You didn't realize we switched over to the true crimes genre here at the Small Business Safari.
Or you can pick up some Dostoevsky too. I mean, it's hard to do worse than Crime and Punishment. That's another great one.
Yeah. Oh wow, that's a big pull. Boy.
War and Peace. Another one. The Russians wrote some great stuff. They a lot of suffering made a lot of great literature. So
what do you think about Atlas Shrugged?
I read Atlas Shrugged. I enjoyed it. I recommend people do it as a pairing with Upton Sinclair's The Jungle. Sinclair's the better writer, but he's a little bit cartoonish, and it's sort of the exact flip side, right? So The Jungle's about this Hungarian immigrant who's just abused and taken advantage of by all the evil capitalists in the Chicago meatpacking industry. Right. And then Atlas Shrugged is about so the innovation and freedom you get from people making their choices and being empowered. And I find reading the two is a great one, because I think Rand's ideas are quite novel, and you don't see enough of them. Sinclair's a great writer, even though his character arcs are a little cartoonish and over the top, right? Like every bad thing that could possibly happens to the protagonist in The Jungle. But the two together make a nice coverage of something that people will debate forever.
I love that answer. That was solid, man. Epic answer. All right, now we're gonna get into more stuff. What's the favorite feature of your home or homes?
Favorite feature of my home. I installed a home gym over COVID. So, I like to lift. And so I installed a squat rack and treadmill and all that sort of stuff. And that's probably my favorite. I need to move and have a sauna. That's my future favorite feature, but I just don't have the space.
Oh, good sauna. Yeah. Oh, I love that too, especially in Colorado. Then you jump out in the snow, jump back in. That's what we used to do up in Michigan. Yeah. But I always thought it was going to be the game camera, as it finds more mountain lions.
Yeah. Well,
you got to see that thing. It was massive.
Yeah, it's big. I don't post a lot of research on Twitter. I'm very, very inactive on Twitter, but if somebody wants to track me down there, you can see the game camera footage. Big cat.
Love it. That's good. What's a personal pet peeve of yours when you're out there and you're the customer?
That's a good question. I mean, I think the biggest one I've run into in the home services industry is lack of follow-up. That's still surprisingly common. And I just don't think there's much of an excuse for it. I think people have to solve that problem.
I think that's so funny.
Quotes on things and just not heard back from people.
So we have an automated quote follow-up system in my CRM, and the responses I get from some people are just absolutely classic. One just said, after literally 2 years of getting an email from us every week, please stop. I'm like, that's all you had to say. That's all you had to say.
Yeah.
It's just, please stop. After 2 years, you're like, come on, man. So yeah, you're right. And when guys don't follow up after they're getting out there, it's something I write on my estimators all the time. You just got to do that because you think you just gave them a free, your consultation for free, but what they sit there looking at is, the opportunity to evaluate your services and what you're doing. And he said, you're our next ambassador in our system. You guys have got to deliver.
Any kind of follow-up. It's crazy to me what's happening in our society. So I'm in commercial real estate. You don't make money unless you sell a building. So you don't make money unless you return a phone call. And it's amazing how often I'll reach out and try to call an agent who's got a listing and I don't even get a call back.
Amazing.
Yeah. Unbelievable.
And that's the only way they make money. And
it's the only way they make
commission
money.
business.
Right.
That's what absolutely flirted. It's 100% commission business, brother. Right. That's what you're in. You know how you make money? You give them a quote, and then
are you doing that well? How would you feel as the person who actually entrusted this person to sell their building and they're not calling people back?
No, you
it drives me crazy.
Yeah, it's crazy. And I do understand why people get there too, right? Because consumers can be flaky. Like I get it, right? Consumers don't respond, or they've got wildly unrealistic price expectations. But some things are just asymmetrical, and that's just one that if you're in that sales role, you've got to eat the fact that a bunch of people are flakes, but you still have to follow up.
That's right, baby. You got to eat. You got to eat the flakes. That's what I took away with you. You got to eat the flakes. All right, Snowflake. All right, let's get back to it. So, last one. Give us a DIY nightmare story.
DIY nightmare story. I've personally never had one. I grew up on a farm, and I've done a lot of DIY stuff. But call this unearned hubris or earned hubris. But I've done a lot of DIY stuff, and I've never screwed it up.
Wow.
So for our listeners, he's cocky talking.
Yeah, I'm cocky talking.
Nobody's allowed to ask my wife that question, though.
I love that one. Yeah, that's a great one. All right, Mischa, this has been great. And I'll tell you, for our listeners, if you didn't pick something up, man, you are totally missing the boat. You're probably going to go back. As I just had somebody tell me the other day, I went back and re-listened to this other episode. I said, yeah. He goes, because there's so much to unpack. I was sitting there in my truck listening to it. I had to go back to my office and re-listen to it. This is the one you want to go back and re-listen to, especially if you're not doing 2024 planning. This is 2023. You're missing the boat. If you didn't do it in January and you're listening to this thing, you still got time, but you better put that 12-month plan together, because a good plan violently executed is better than an excellent plan never put in place. Go out there, make it a big day. Let's get up that mountaintop and watch out for those big cats on your way up to the top.
Cheers. Thanks, Mischa.
See you guys.